Thanks so much for tuning in to Talking Point. I'm your host, Neeraj Shah. It's never a bad time to talk to Shankar Sharma, but it's also a very opportune time to get him on air simply because uh, the, 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 the arguments for and against what the equity markets or the investing at large could do have never been so disparate in the last 12 months that I've seen. Shankar, great having you. Thanks for joining in. I hope all is well with you.
Yes, absolutely. Rocking, as I just said prior to the interview commencing.
Yeah, well, so how do you make it rocking, Shankar? I'm trying to understand simply because the arguments around whether the higher interest rates will keep on impacting markets over the medium term are very loud, as are the arguments that, hey, the opening up world will bring about economic growth at some point of time, hopefully, and valuations have corrected a little bit. How are you approaching this?
So, I mean, there are many arguments for or against any market situation permanently. It's nothing to do with now. There is enough at any point of market history. There will be enough arguments to support a bear market thesis and enough arguments to support a bull market thesis. So the interesting thing is all those things are logical. All those things can work, but it depends on the market whether it chooses to focus on one or the other. The decision on what the market what the market's own feel for direction is based on the market's own decision to pick a bull argument or a bear argument. And the same argument in a young bull market, I mean, a bear argument in a young bull market will not derail it, but the same argument in a mature bull market will derail it. So a war in a young bull market will be shrugged off, saying it's okay, it's temporary, 4, 5 months, 6 months, a year, it's okay, market will look past it. But when it comes at the end of a 12 or 13-year long bull market, it has a disproportionate impact. Inflation can have the same effect, right? You can always argue that this is temporary, this is transitory, or 6 months down the road, it will be the base effect will kick in, and therefore these numbers optically will look, I mean, inflation will look lower. But that argument will work when the bull market is young, when it is an aging bull market, as it has been in the world, not so much in India. India has actually not had much of a bull market, to be honest with you, from 2008. But ignore that for a minute. So therefore, the way I'm looking at the market is very simply this. The markets were and when I say markets, I'm saying more the US market or the global markets rather than India, again, to clarify, were looking for a reason to fall because they had gone on for too long. And in particular, 2019, 20, and 21 were solidly up years, were massively up years. Statistically, you will always have a down year in the fourth year. Okay. It has never probably happened in the history of the world that you've had 4 consecutive up years in markets. So markets were looking for a reason. Now, there are enough reasons out there, a war or inflation or crude or something will be there. Okay. So I'm not surprised at what the market has done. It was, in fact, by the middle of last year, I was very clear that 2022 will shape up to be a difficult year. I didn't know the reasons why, but I knew statistically it was due for a down year. And we are getting exactly that.
It's something that you pointed out in the last interaction as well. So yeah, I should have kept note of that. In which case, Shankar, is 2022, as things stand as of now, a year of capital preservation more so? Or do you reckon that you are still going out there and trying to make the alpha or the delta, as the case may be?
I'm absolutely going out there and doing all the Greeks, as whatever other Greeks might be there from alpha and delta and whatever else there is, to create a portfolio which will last solidly for the next 3 or 5 years, because the bear market is a tremendous friend. It's not an enemy. We have regarded it as an enemy for all the wrong reasons. So here is my thesis on a bear market. Okay, I have got every single bear market right from in the last 22 years. I've never got that wrong. I might get a bull market wrong once in a while, but that's okay. There is enough ways to make money on the long side. But if you get a bear market right, here is what happens. Okay, you get two things. Number one, you don't lose as much money. So when I said that I'm rocking, okay, It doesn't mean that I'm not losing money. I'm losing money, but I'm not losing as much as the average investor, Joe investor on the street, who goes out there, listens to people on coming on television saying all is well permanently. Okay. And that's why they are destined to never get seriously rich in the markets. Because when you spot a bear market from a distance away, you positioned yourself through a variety of means to not lose as much money. You will get hit. Okay. But you will not have a 80% down or 50% down. Okay. You might be down 20, which is easily recovered. And the second thing is that the way you will recover that 20 or 30 that you might lose in a bear market will be by a rotational switch away from the losers in your portfolio, the significant losers in your portfolio, to what is winning in the markets. So even right now, okay, to give you live example, there are enough stocks, let's say the larger basket or the small or the mid cap universe in India, which are trading near about highs. The index is down, I think, 20-25% in the last couple of months' time. There are enough stocks which are trading at highs. That is the group you need to belong to. If you don't belong there and you're going to nurse your losses, you're never coming out of this hole in a bear market. Okay. I also have losses. I've got stocks which are down 40-50%. This calls for ruthlessness in eliminating those and buying strength, which is why a bear market is a great place to build core strength in your portfolio. Don't fear it.
Interesting. Shankar, can I ask you about the mental makeup? Because if a stock is nursing, if a good stock is nursing 30, 35%, 40% losses in your portfolio, it's there simply because you believe that the business is good in the first place for you to stick to it, right? So how do you get that mental makeup of switching out of it at the lowest possible value that you've seen in the last 6, 12, 18 months, as the case may be?
So I don't care. As far as my one of the things about maturity in investing is that you become fairly stoic in your thinking. I regard this as a giant game in which I will lose a few times for sure. I mean, statistically, I will lose 30-40% of the time. If I'm very smart, if I'm an idiot, I will lose 90% of the time. But I'm not going to win 100% of the time. It's not going to happen. Most investors and even the intelligent ones think this is a game in which they'll win most of the time. It doesn't work like that. Okay. So first that realism comes that, hey, something in my portfolio is wrong. That acceptance is half the battle won. And the tape is telling you, learn to read the tape, learn to accept the tape, learn to embrace the tape. So I'm embracing it. I'm saying a good stock should not be down 50%. Okay. Therefore, there is something fundamentally flawed in their business. Maybe the war has hit their supply chain very much, or there is something wrong. Good stocks will not fall 50% in a bear market. Good stocks might fall 20, 25, tops 30. Therefore, you have a problem right there. And that's the time when you will sit and take a look at your portfolio that, okay, some stocks are doing well, but there is a group which is not doing well. But at the same time, there's a group out there in the market which you don't own, which is doing fabulously well. You need to switch out ruthlessly from this into those. That is a fundamental principle. Stick with the winners. Get out of the big losers.
Got it. Okay. I will first talk about a few topical things, then try and understand where is it that Shankar Sharma is trying to or building his portfolio thematically for people to maybe take advantage of. First, the news flow. It's a big one. The largest insurer has listed at a discount on unexpected lines, one would say. What does this say about the theme as well? Because somehow, as much promise as insurance held at 3-4 years ago, the stock returns have been abysmal, and LIC probably is part of the same game, so to say.
I mean, I find it absolutely absurd, when educated fund managers come on television or in print and say the insurance is a great industry, India is underpenetrated and this and that, and therefore buying an insurance stock is going to be great. Because buying private sector banks back in the 90s was a great trade. Okay. I mean, I say, guys, private sector banks, when they listed some of them, and there was HDFC Bank, which was the main one, and then Kotak Bank, because, it went through a few avatars at NBFC and then a bank. The reality is that those banks listed right in infancy of their businesses. They did not list when they had already reached a huge size in terms of, assets and profitability. In our case, all our insurance companies that listed in the last 3-4 years listed when they have already reached a very significant size and scale of operations. Therefore, most of the value is already captured at the pre-IPO stage itself. And that's exactly where LIC belongs. LIC is no spring chicken. LIC is the oldest game in town. It's just that it's now come out into the real world. It's been around, decades, guys. You're not going to make outsized gains in companies that have already reached that size and scale. So you cannot compare insurers to private sector banks that listed. HDFC Bank listed, I think, within a couple of years of its starting operations from a little office in Worli. Are any of these guys in that situation? No, they're not.
Got it. Okay. Fair point. And therefore, from a business case perspective as well, or from a market gain perspective, insurance as a parcel, you don't think is going to make you the gains that you desire, at least.
So, insurance is a business which very few people understand. It is a huge marketing machine at one side, and it's a huge investment machine at the other side. And to make both ends of the machine work very well is not an easy task in the first place. Second, the data for India is not that comforting from a under penetration standpoint. Okay. Because the amount of premium that is generated relative to GDP is not small. It is actually a fairly significant number already. It's actually higher than most emerging markets. So, per capita skews the whole thing. Okay, because India has a large base. But on a GDP comparison, it's not that we collect very little premium. There's a big headroom available. So it is an average business in my view. Okay, it's a great business if these guys had listed at the infancy of the news. Obviously, in LIC, that's not possible. In the other guys, that might have been possible. But most of the juice has been sucked out already from at the point of their listing. So whatever might be the business, I'm interested in buying a stock that makes me money. The business might be great, but what is the use for me as an investor if all that business is already captured in the valuation at IPO time?
Yeah, that's true. Shankar, I want to also ask about cement, as you would have guessed. But before that, since you raked up the per capita point, can I ask you? I've heard arguments from some money managers of late about how certain sectors consolidating when the per capita is quote unquote $2,000 in India make them ripe for stupendous gains at some point of time when the per capita improves, if it does, when it does. And telecom, media, etc., come out as examples of people saying that we are investing here because we believe that in 3, 4, 5 years' time, with the per capita moving up, these industries will make a lot of gain, and the two-player industry will actually benefit both the players. How do you kind of read the tea leaves here?
That's a valid argument. What they are not saying, maybe they have not gotten to that line of thinking, is a larger point here. Merely because something is a two-horse race doesn't make it necessarily attractive. If you look at telecom, for example, okay, telecom is a very, let's say, a game of very few players worldwide. Okay, in every country, they are not like 15 manufacturers of those services. There are maybe 2 or 3, tops 4. But the stock price performances have been terrible.
Yes.
You've not made money buying telecom stocks for decades now, anywhere in the world. Okay. So, just that argument itself is flawed. That, merely because, you have a 2-horse race, it's going to be a, big sort of upside out there. The larger reason to think of why it might work, okay, there is an argument in favor of that broad thinking, is that I think because of the collapse in VC funding, which is happening and will happen, a lot of the disruptions around industries will cease. Okay, so there will be consolidation, and on the other hand, entry of new the barriers to entry because of a capital scarcity will increase, which will make it better for incumbents in consolidated industries. That's really the bigger thing that I think will play out. We will see how it works out sector by sector, but I think that is an important aspect to focus on as well.
Okay. Media in India hasn't just made money. Do you think it
Tell,
can?
you tell me, you're now in
No, but seriously, I mean, all brevity aside, what's your sense?
I think media is, I mean, if you talk from a business standpoint, I think it is rubbish. Okay. Okay. From a mouthpiece point of view, it's fantastic. That's why business people worldwide want to have a piece of media. And that's a different consideration than what a minority investor might have.
Sure.
So, you have in India, I think last I checked, there were 400 TV channels across India, little in every in Jharkhand, there will be 4, and in Tamil Nadu, there will be. And these are all locally controlled by politicians because it furthers their agenda, or by little business people here and there. Are they going to make money for a guy who's a minority 2% holder? No way. But it's great for these guys. So media being owned by tycoons and barons is good for them. It's not necessarily good for the average investor on the street.
Okay. The other news specific view that I wanted before I ask you about where is it that you are filing on the gains, so to say, cement. You had a really large transaction happen. Does it, to your mind, alter the way the existing players in the country's fortunes change or don't change?
Yeah, it changes. I mean, of course, again, we've seen a lot of M&A happening in cement. We've seen a lot of M&A happening in steel. Both industries have kind of consolidated over the last decade or so. A lot of weaker players exited. And this is again in line with the same it takes it to the next level altogether. I think it augurs well, in my view, for the existing players. I don't think it is bad for existing players. It augurs well for the industry itself. So I have no problems with this transaction from the cement industry's perspective.
One argument is, or the two arguments here, I'm just trying to understand, just trying to explore this. Somebody was talking about this yesterday, that there is a player who is not necessarily going to be a marauder of prices, so to say. He wants profitability and he's come in, and it kind of attaches a base to the valuations at which the deal is done. And the contra view is that there is an aggressive promoter. He will vie for market share, and it might be negative for the existing players.
I don't think they are going to play a price game. I really would be very, very surprised. And there might be some pricing here and there, but I don't think it is going to be just like a bloodbath kind of pricing scenario looming up. I would really, I don't think a smart Gujarati will play a loss-making game.
You think the earlier Gujarati was not that smart, Shankar? Just saying.
I don't think there is anything like a foolish Gujarati in the first place.
Should I take that as a compliment?
You must. It is directed more at you, Dheeraj.
Thank you so much. Okay, now may I ask you, Shankar, when you told me that you are thinking of building a portfolio which could last 3, 4, 5 years, and I'm sure things will change over a period of time as events change, etc. But as things stand, where is it that you believe there could be gains to be made over the next 1, 2, 3, 5 years?
Well, I think small caps, and small caps. That's it. Large caps are done and dusted. If your expectations are a 15, 20% compounding, they are not going to give you that. Not large caps. If your expectations are those, you would need to go out there, hunt, work hard, create a portfolio of small caps and mid caps. And I think there is plenty of choice out there. It's amazing. This correction has given us some amazing bets. That's the place you will beat the market significantly, because I don't think the headline indexes are going anywhere fast. Given the composition of financials and autos and even a behemoth like Reliance, okay, I mean, for them to deliver 20% CAGR I think that's a reach. But there are any number of companies, small and mid-size out there. I mean, I'm going to India, in the next couple of days, again, meeting several companies. So my trips to India have multiplied rapidly in the bear market.
How interesting. Okay, so are these very, very bottom up, or there are some themes attached to this as well, which you are trying to explore?
Completely bottom up. I mean, one company has no similarity with the other, and that's the beauty of it, that you're building a portfolio which is not highly correlated. Because, if you buy similar companies in your most of your portfolio, then effectively you bought one stock, right?
True.
Here, because the small caps are so diverse and so heterogeneous, they're not homogeneous. You build a highly uncorrelated portfolio. And I'm 100% sure that of the ones that I buy, 30-40% will absolutely lose money. I mean, that is almost a given. I accept that before even I put a rupee to work. Okay. But I mean, I think of that 10-20% will be absolutely out of the park hits. And that's the way this game works.
Okay. So obviously, I don't want to probe into what names are because that would be unwise. But can I end this interview with the last two questions? And both of them are slightly, one is market cycle link, one is global markets link, because you are such an expert on those. One is an argument that I started to hear a lot, that the multiples that were paid in a more liquidity driven market with the central bank put over the last decade for growth stocks will now not be there. So people need to understand that they can't compare the multiples paid to, let's say, high growth companies in 2017, 18, 19 for the future. Is that a valid argument?
Yeah, 100%. I mean, the single biggest determinant of PE ratios is really the cost of capital. And if cost of capital ratchets up 2x or 3x in the West, I mean, in the US, which it's clearly going to be like that, your multiples will compress because the PE multiple is nothing but earnings yield. So the reciprocal of P is E by P, which is your earnings. So 10 times P is a 10% earnings yield. Okay. And that is you have to compare it against the risk-free rate in order to arrive at what is a fair market multiple. And if you're projecting rates out to go to 4 or 5%, okay, at the highest in the West, you should be prepared to pay on a broad basket not more than 15-20 times earnings if you want to equate your earnings yield with that of the bond yields. In India, which is a typically higher interest rate regime, a 7-8% yield will, you should be, broadly speaking, prepared to pay 12 times, tops 15 times multiple for the average stock. When you have rising interest rates, a 15 multiple will collapse to a 10 multiple. We are seeing that happen as we speak.
Yeah. So you reckon the days of Asian Paints, Titans, Dixons, or even the two IT majors really getting very high multiples relative to history are now history?
Yeah, I mean, for one, I mean, you can go to Taiwan and buy outsourcing or contract manufacturing companies at 10-12 times earnings, and here we have 100 times earnings for commodity producers making 3% margins. Absolutely bananas. I mean, India, clearly Indian, and thank God we don't get so much global news for valuations. Otherwise, this market would be down 80% overnight. Because same businesses elsewhere, 10-12 times earnings in Taiwan and in China, you can buy truckloads of these companies and they come to India or similar businesses and they trade 100 times earnings. How long can that last? A grocery chain in India with a 1,400-1,500 crore profit trades at 2.5 lakh crore market cap. I mean, it's absolutely insane and ridiculous. No metric can justify that. You will see multiples collapse. Okay. Even though they are companies owned by very good friends of mine, but that's a different discussion. The fact of the matter is valuation, and you cannot ignore it permanently.
Awesome. Shankar, my final question. This whole argument about a hard landing versus a soft landing will capture the imagination over the next 12 months. How are you thinking about it? How does it impact your investing framework?
I think the US is in for a hard landing. No doubt about it, because we have gone on too easy, too long. And the unwinding is not going to get over in 6 months' time. It's going to be a painful way out of this slowdown. And I believe there's a lot of slowdown in consumer spending in the US based on anecdotal evidence. I tweeted about it yesterday. I think the US in particular is the country to watch out for signals for the rest of us, because there is going to be a long and painful journey out of this excess, if you can call it that, built over last 10-12 years.
Shankar Sharma, always a pleasure talking to you. Thank you so much for your time today.
Thank you, Neeraj, for having me.
A pleasure is ours.